from what types of accounts should you be withdrawing income? So let's say you're in the 55 to 65 age range, and you're starting to take income. How do you decide from which account to take income? That's one of the many things we have control over. We can't control the markets or geopolitical happenings, they happen, but we can absolutely control from which account we take income and when. Hello, everyone. Good afternoon to you. We'll go ahead and get started with today's Sweet Financial Live. So I'm Oliver Kolofsky, Director of Wealth Services and partner here at Sweet Financial Partners. And today we're going to talk about financial planning opportunities for those folks age 55 to 65. And if you're not quite in that age range, that's fine. If you're a little younger or a little older, but a lot of what we'll talk about today, everything we'll talk about today is going to apply within that age range. And some of the things we'll chat about will apply a little bit outside of that age range. So again, I'm Oliver Kolofsky. My email address is there on the screen, oliver@sweetfinancial.com. And I do check that daily and do reply. So if you have questions based on anything we talk about and you don't put something in the chat box, that's totally fine. Feel free to email me, again, oliver@sweetfinancial.com, and I certainly will reply. So we're going to discuss 4 items today listed on the screen. So how and when to take Social Security income. Number 2, we're going to spend the most time on this one. It's how your income impacts cost of your health care. To what types of accounts should you be contributing? And then from what types of accounts should you be withdrawing income? And again, we're going to spend the most amount of time on item number 2. And we could do a whole probably a 45-minute session on each of these topics. But we're going to go into some depth on each of those, and especially item number 2. So let's go ahead and get started. So let's start with the item number 1. So how and when to begin Social Security income. And I apologize, but for a lot of the things on here, I'm going to say like, well, it depends, or for most, or generally. I try not to use those terms, but in some instances I will have to. So the first item is, for most, you'll begin Social Security income, or you could, as early as age 62 and as late as age 70. So there would never be a time where you'd want to wait beyond age 70 to take Social Security. And there are certain instances, like if there's if you're a widow or widower, you could begin as early as age 60. But for most, it's somewhere between the window of age 62 to 70 is when you would begin Social Security. And there's sometimes some misinformation out there that you have to wait like till your birthday. Like if you don't start at 62, well, I got to wait 12 months all the way to age 63. That's not true. You can start any month in between. So you can really start any time. So there's a key number that you want to identify. It's a big number, or not a big, it's an important number, I should say, as it relates to Social Security. That's what's called your full retirement age, sometimes referred to as normal retirement age. And that's determined by your year of birth. So over here in the left-hand column, we see all the years of birth. And then you can see anyone who was born 1937 to prior, it was 65. And that number's slowly been increasing all the way up until anyone born 1960 or later. Full retirement age is 67. And at some point, they're going to need to, they being the government, are probably going to need to put some additional age brackets in there where the full retirement age would be even higher. So I'll give you a moment, find your year of birth, look over and find your full retirement age. You notice it's somewhere in the middle between age 62 and 70. And why this is important, if you're still working, meaning you have earned income, be aware that if you're considering starting Social Security before your full retirement age, so let's say you're born in 1960, if you're considering starting Social Security before age 67, so like from 62 to 67, your benefit is going to be reduced if you earn a certain amount of income. Why that is your Social Security benefit is reduced $1 for every $2 you earn over the number there listed on the screen, or $19,560. And that $19,560, that indexes every year a little bit with inflation. So that's the 2022 figure. So a few common questions that we hear from folks on this one is, what exactly is earned income? Earned income is two things. It's income earned from working, so W-2 wages, or self-employment income. It's not, let's say, rental income. If you own farm ground or own a rental house, that is not considered earned income. Or if you already somehow started a pension from a prior job and you're still working at a different job, that pension income is not considered earned income. One common question. Second common question is to say, okay, I retired, let's say at age 64, but my spouse is still working. My spouse has earned income. Does that preclude me, or does that impact my Social Security in terms of being under full retirement age? The answer is no. It's based on your earned income, or if you have earned income, not based on your spouse's earned income. And if you have, other income, rental income, investment portfolio income, not considered earned income. Or if you just earn under $19,560, then there's no issue there. So that's knowing your full retirement age. That's key. That's item number one. I'm just going to glance over here to see if we have any questions coming in. None at this point. Item number two. So if you can take Social Security anywhere from age 62 or 70, what's the difference? Why take it 62 or 65 or 70? Well, think of it this way. If you get roughly, and we're approximating here, roughly 6 to 8% growth for every year you wait to begin taking Social Security. You can look at that two ways. You can say, well, if I start later, I get growth by waiting. I get that roughly 6 to 8% per year. Or you can look at it the other way and say, if I take early, like let's say at 62, I get a reduced benefit from what it would have been had I started at like 67 or 70. So earning an extra 6 to 8% return, that's a pretty darn good rate of return. So if we look at this hypothetical person here, a single person, their benefit at age 62, that would be the earliest this person could collect, $1,400 a month. Again, could take it 63, 64, 65, 66, so 67, it's $2,000 a month, so $600 a month more. And if we wait as long as possible, age 70, remember you wouldn't want to wait beyond age 70, it's $2,480 a month. So there's definitely some incentive for waiting. We sometimes get asked the question, well, is there like a break-even point? Meaning if I pass away at a certain time frame, should I have taken it sooner rather than later? Like in the instance on the screen, yeah, the person's getting over $1,000 a month more, but they went 8 years or so without getting that $1,400 a month. And the answer to that is, it's roughly, approximating here, kind of in the early 80s, 80-ish to 82 is typically the break-even point for most folks, meaning if you were to pass away at age 80 or 82-ish, whether you started Social Security at 62 or age 70 or any age in between, it really didn't matter from the total income you received over your lifetime. There's a little more to that, and that's going to be on the next slide. And that's this one here. So how does Social Security work when one spouse passes away? Well, the surviving spouse ends up with the larger or the higher of the two Social Security incomes. And they use like a goofy formula, but they end up at the higher of the two Social Securities. So the smaller of the Social Security, the smaller of the two Social Security income goes away. So why this is important? It's important because sometimes we have folks who are, let's say maybe they were the higher earner of the two spouses during their working years, and maybe that higher earner is maybe not in as good of health as their spouse, or maybe that higher earner is a lot, let's say, a lot older than their spouse. There's a big age difference. Yeah. So sometimes that person will say, well, gee, I'm maybe don't have great genetics or not in great health, I might lean towards taking it like 62 or 63, something kind of early, which is fine, but we'd encourage that person to look at it slightly different. That you wouldn't, the higher earner of two spouses wouldn't want to say, I want to look at my own life expectancy. They would want to look at the life expectancy of the two of them as of the couple, because once that person, if that person does predecease, the higher earner predeceases the other person, we want that person, the survivor, to ideally get a larger income amount. And if the person would have started at age 62 or 63, the Social Security amount wouldn't be as large as it otherwise would have been. So it's not in a married couple type of situation, it's not as much of an individualized decision, but we would look at it as a joint decision and something we go through as part of the Dream Architect planning process. So I'm going to pause there. All righty. Next item, there's a lot of information on this slide. I'm not going to go through all of this. I'm going to highlight a couple things, because this is where it really gets nuanced. If there was a divorced situation, or if there was a widow or widower, and maybe you have two types of things. Maybe there was a divorce and then a widow type situation. Then there becomes a lot of moving parts. We have software for clients. We can run all this and go through all the options, and in the reports, the visuals are produced by the software. So it's great for conversation. So if I look at an example here, a divorced spouse in the middle column, in order to claim benefits off their ex-spouse, they would have had to have been married for at least 10 years. So I guess I wouldn't call it a joke or whatever, but something that someone has said in the past. Well, if you've been married for like nine years and 11 months, and the person there might be a divorce, and that person's a much higher earner than you might want to wait like 10 years, delay the divorce a little bit, because then you're able to claim Social Security, a higher Social Security benefit off that person, even if you're not married to them. Now, there's catches or caveats to that. If we were to look at the bottom, you must remain unmarried when you file for divorced spouse benefits. So this is where it gets much more nuanced, and we could do the whole 45-minute session just on one of these. And you can see this is like the disclosure that goes with that prior slide. There's a lot of ways that this can work out. So that's Social Security. I'll pause there. I'm going to check over here to see if we have any questions. All right. So number 2, and this is where we'll probably spend the most amount of time, is how your income impacts the cost of your healthcare. We're going to divide up cost of healthcare in 2 ways. One, prior to you turning 65, and then 65 and beyond. Because age 65, most people would go on Medicare. That would be their health insurance. So we need to define some things. Income can mean a lot of things. So what are we talking about here? What does income mean? So income, it's a number that's on your tax return, and we're going to look at a tax return momentarily, or is derived from a number on your tax return. So income and monthly cash flow are not synonymous. So let's say your monthly cash flow is $4,000 a month, $48,000 a year. Maybe you take some out of your account, you get some Social Security, it's $48,000 a year. Nowhere on your tax return, unless it just out of coincidence, is that $48,000 number going to show. It will not show on your tax return. So income, we're going to, for the purposes of this discussion, is going to be a number that is on your tax return or is derived from a number that's on your tax return. So income and monthly cash flow are not interchangeable. They're not synonymous. We're going to have people with really high monthly cash flow, low income on their tax return. Yep. So there's actually 4 numbers we're going to talk about that that determine the cost of your healthcare. Actually, 3 of them don't, but I threw in a 4th number. I'm going to go on a little bit of a tangent at the end of this one. But so we're going to look at taxable income, adjusted gross income, and modified adjusted gross income. So let's look at a tax return. This is a 2021 tax return, and I'm going to grab my pen here, virtual pen, so to speak, so I can draw on this. And let's look at a few things. Let's go line by line a little bit. So here's wages and salaries, line 1. We can see there's nothing there. There's no self-employment income either. So this tells me the person is retired. The next item, we can see that they took $24,000 out of the IRA. That's line 4A. Line 4B is going to show the taxable amount, which is the same, which leads me to believe this person is under age 70 and a half, because I can look down here and see that they gave money to charity. The maximum you could deduct on this line was $600, and they gave $600. But if this person was over age 70 and a half, and they're taking money out of their IRA, this is a little bit of a tangent. There's a way they could, it's called QCD, way you could have this give the charity using the IRA, so that instead of this showing, well, this would always show 24, but this could show less than 24,000. So 3 more items I'm going to share on here. Social Security. So this gross Social Security benefits for just over $27,000 for the year. The taxable amount of Social Security, $8,312. So only about 30% of Social Security was subject to tax. The maximum, and we'll go through an example later, is 85%. 85% of that $27,000 could be subject to tax. This person, only 30% or $8,300 was subject to tax. So we see this term as on your tax return called adjusted gross income. Adds up all your income sources, $41,500. You get a deduction, and then we come down here and we get taxable income. So let's focus on these 2 numbers right here, the adjusted gross income, taxable income. Adjusted gross income is all your income before deductions. Taxable income is just that, it's your taxable income, so it's your income after deductions. I'm going to remove my drawings there. Okay, so we've defined 2 of them. We just defined your taxable income, and we saw it on the tax return. We then defined and saw your adjusted gross income. That's on your tax return, it's actual line on your tax return. The next one is modified adjusted gross income. This is a big one because it's going to determine the cost of your health care both before age 65 and after 65. Modified adjusted gross income shows nowhere on your tax return. You're not going to find a line that says my modified adjusted gross income. So in essence, what modified adjusted gross income is, it is your adjusted gross income. So right here, what's on line 11, and it's going to add back your non-taxable Social Security income. So we see that's about $19,000. So total Social Security, $27,000, taxable amount, $8,000. So like $19,000 is the non-taxable portion of Social Security. So if I was to do a calculation, what's modified adjusted gross income, we can look at adjusted gross income is $41,000. Plus we just looked at $19,000 of untaxed Social Security. I add those 2 numbers together, it's like $60,000. That doesn't show anywhere on your tax return, but we've got a big variance. So we got a modified adjusted gross income of $60,000, and we've got a taxable income of $13,000. And so when we're looking at, again, the cost of healthcare, they're looking at modified adjusted gross income. So if someone just casually says to you, well, cost of healthcare is based on your income, well, it's the $60,000 modified adjusted gross income, where someone might look at the tax return and say, okay, my income's line 15, taxable income, $13,000. Okay, so we have to define all those items. Very important. So these are the tax rates. We'll come back to this. This is like the $13,000 taxable income gets applied to the rates. But let's look at before age 65. So if you're under age 65, you get reduced cost health insurance, the exact same health insurance anyone would get, but it just costs less. If you meet certain parameters, it should say parameters there, including having modified adjusted gross income under a certain threshold. And that threshold, they don't publish the numbers like they used to do. You have to go in and use the calculator, like if you're from the state of Minnesota, on the MinSure site. But it's roughly, if your modified adjusted gross income is roughly under like $48,000 for a single person, and I think it's like $68,000 or something like that for a household of two, you're going to get lower cost health insurance. You know, but remember, it's derived from numbers on a tax return. So you could cash flow a really large amount, but not show much income on your tax return and be able to get this. So a couple of strategies real quick. If you take Roth IRA distributions, Roth IRA, qualified Roth IRA distributions, Roth is tax-free. Roth IRAs don't show on your tax return anywhere. Might be a time if you're trying to get low-cost health insurance, that would be one option. Because sometimes we have people say, well, I'm not going to retire until age 65 because I can't afford health insurance. And sometimes that's right. And sometimes that's not right. That if you've got certain income sources based on how your portfolio is lined up and you retire prior to age 65, you could get health insurance for almost for very low cost. That might be true, but it's not always true that you can't afford to retire due to health insurance costs. Right. Back to strategies, withdrawals from non-IRA accounts. If you've got like a joint account or something that's not in an IRA or not in a Roth IRA, where only a portion might be taxable, you could use that. Bank accounts, just have some extra money in the bank, you take that out, that's not taxable. Lines of credit, we've had so far as people get like a home equity line of credit and they take money off that because that's a loan is tax-free. Once they hit age 65 and they're subject to different thresholds, then they take money out of the IRA, which would otherwise be taxable, or it is taxable, but they take that money out of the IRA and pay off the line of credit after age 65. So that's pre-age 65. Now let's talk about those who are age 65. Now you're on Medicare. And I'm going to grab my pen again, so I'm going to look at my other screen. And again, any questions, feel free to type in the chat box. I've got one question that already came in here on, I'm going to get to that in just a moment, on the Medicare, how it works on timing for Medicare. So Medicare, there's two parts to Medicare. Part B, which is kind of like your normal health insurance, and Part B, which is the prescription drug. And everyone pays $170 a month per person for Part B, $170.10. Over here is your income. If you're single, if your income's $91,000 or less, that's what you pay. And if you're married filing jointly and your income's $182,000 or less. But of course, we have to define what income is. Income is modified adjusted gross income. Income before deductions plus non-taxable Social Security. And there's actually a couple other non-taxable things like that it could add back there. So there's a surcharge right here, the word surcharge, which means you pay a little more. You don't get anything more, but you pay a little more for Medicare if your income is over or within certain thresholds. So if you're single and your income's between 91 and 114, or you're married and your income's between 182 and 228, pay an extra $68 for Part B and an extra $12.40 for Part D. And that is per month per person. So an extra $80.40 per month per person. This, and the question here was the timing. It's a 2-year look back, or you could look at it as a 2-year look forward. So someone's 2022 Medicare cost is based on the 2020 modified adjusted gross income. So it's a 2-year look back or look forward, however you want to look at it. But whatever if you have a big income year this year, it's going to impact your Medicare cost in 2024. So 2022 Medicare cost is determined by 2020 modified adjusted gross income. This is what's called a cliff basis. The surcharges apply on a cliff basis, meaning if you were to go $1 over, let's look at the single here. If you're to go $1 over, you're going to pay the surcharge. So there's an example below here. Bob had if he has as much as a $91,000 on his single return, he'll owe no surcharge. But if his income was $91,001, then a monthly surcharge is at $68 for Part B, $12 for Part D. It's $80.40. So if you read that paragraph below, again, that's per month. So he went $1 over. Went over the cliff by $1. So his premium for Medicare just went up for that year, $964.80. So if you're close to that cliff, there are things in most cases that you can do to not realize income, or certain things you can do to reduce your income slightly. So that is where it can be a situation where you get really close to the cliff, and it can be awful expensive to have $1 over. So, I mean, you could say, well, that's a surcharge is another name for a tax. So if you calculate what the tax is on that $1 of income, there's thousands of percent there. So again, this is something we, for those of you who are clients on this Sweet Financial Live, something we've got the software for, and something we will continue to have conversations with you about, because this is something we can control from which account you take income and when. We can't control the markets going up and down, but we can absolutely control, for the most part, from which account we take income and when. All right, I'll clear that drawing. We answered that question. Oh yeah, I had a little bit of a tangent, didn't I? Let's get to that. Item number 4, we had a question. So there's actually one other number. Doesn't have anything to do with healthcare, so that's why it's a tangent. But there's actually another number, and this number is nowhere on your tax return either. And just looking at the attendee list, not all of you are from the state of Minnesota, but this one is for folks in the state of Minnesota. If you were to get your property tax statement, or when you get your property tax statement, it's going to show what your property taxes are for the year. And that, we call that kind of the sticker price. And most people pay the sticker price, but there are some people who don't pay sticker price or don't pay the published rate of their property taxes. So again, if your income, as shown on your tax return, is under a certain dollar amount, and your property taxes are of a certain amount, you may get a property tax refund. They look at like a matrix and say, well, your income's this and your property taxes are this. Do you get a property tax income or refund? And an income, again, it's a number that's shown on a tax return or is derived from an income on a tax return. So an extreme example would be, let's say someone had $10,000 a year property taxes and they showed no income. They were retired. They just lived on, took money out of the bank, and that's what they lived on for the year. So they showed no income on their tax return. They would get a really large property tax refund. Instead of their property taxes being $10,000, it would be nowhere close to $10,000. But or Roths, we say Roth IRAs are always tax-free. Well, there's a 32-page document that the state of Minnesota publishes in calculating. It's actually the modified adjusted gross income. You have to add back if you, even more. If you look on page, this is page 8 of 32. There's some fine print here. I've highlighted it. Roth IRA distributions for the purposes of getting a Minnesota property tax refund, which can be pretty sizable. You have to add back Roth IRA distributions. And just to the right of what I've highlighted there, you have to add back traditional IRA not included on line 1, including distributions made to charity. So that I referenced this maybe a little quick earlier, that if you give money to charity, it's not counted as income. If you give it out of your IRA and you're over 70.5, well, that's true. But for the purposes of getting a Minnesota property tax refund, it is considered income. So to get the Minnesota property tax refund, it's like modified adjusted gross income plus adding back like Roth distributions or IRA distributions that were given to charity. So it's a whole nother calculation, if you will. The key things, that's page 8. Page 9 would be, if you took money out of a non-IRA account, that's how you would get around this. So that's segues to the next slide. These various buckets of money, common buckets of money that people will have in retirement. So you have pension or land rent. Some people have that. Everyone or virtually everyone's going to have Social Security. You have IRAs, Roth IRAs, and non-IRAs. So how to get around the Minnesota property tax refund is you'd have to have money in this far right bucket where only the gains are taxable, where you could take like basis distributions out. That's getting fairly technical, but having diversification of income sources, different buckets of money, if you will, is just as important as investment diversification. All right. So that's a lot. Again, you could probably see how we could go, almost 45 minutes just on that one alone. So item number 3, to what account types or types of accounts should you be contributing? This again, we've got kind of 3. The 3 on the right is what you could contribute to. You don't, I guess by working, you automatically contribute to Social Security. So those are the 3 on the right. So let's look at tax rates now versus tax rates later. When they passed the tax cuts in 2018, they did it for, the way it works is the tax cuts last 8 years, 2018 through 2025, and 2026, they revert back to what they were in 2017. So what I want to grab my pen here again. This is for married couples, married filing jointly. The same concept applies to single people. The numbers are just different. So 2022, if you have $340,100 of income, the most federal tax rate, the largest federal tax rate you'd pay is 24%. If we look at 2026 and beyond, if you had $83,551 of income, the largest tax rate on that last dollar of income, pay 25%. If you have 1/4 the income, you actually pay 1 more percentage point in terms of taxes. And of course, Congress could act at any time and change the tax rates, but as they are right now, we're in a really low tax environment, especially under about 340,000 of taxable income. This taxable income. I'm going to clear that. Now let's look at joint versus single tax rates. And some people will say, well, I'm married, so I only need to worry about the joint tax rates, which is correct. But, someone, unless a couple passes away in the same year, someone at some point will be filing a single tax return. So let's look at it, like $80,000 of income, let's say. Married filing jointly, the current tax rate, 12%. 12%. So when one spouse passes away, generally the income doesn't change a whole lot. The taxable income, one Social Security goes away, but it's the smaller of the 2 Social Securities. So generally the taxable income doesn't change much. Well, let's say it did change, went down by 10,000. So instead of 80,000, 70,000. Well, let's look here at the bottom. These are the single tax rates, $70,000 of income. 22% is the max tax rate you'd pay. So $10,000 less income, but almost double, not quite double, but almost double the tax rate. So having more money in Roth can make some sense. You don't get the tax deduction right now, but one could make the case that with tax rates low right now, the tax deduction is not as valuable. as it will be like in 2026 and beyond. I think we're going to go a little long, so it's kind of scheduled through 4:45, so Central Time, so another 10 minutes. We're going to go a little bit long on that. So how do you get money in a Roth is a common question. So there's three ways: a Roth IRA contribution, a Roth 401k contribution, and a Roth conversion. And there's different parameters or qualifications for each of these. And last month, Amber Knips, financial advisor here, she spent her Sweet Financial Live, that topic went through each of these in detail. And that's on our website. If you want me to send you that link, you can email me at oliver@sweetfinancial.com. Otherwise, it's on our website. So I won't go into I won't go into detail here because there's a full 45 minutes where Amber in last month's Sweet Financial Live went through this. But having some money in a Roth, in a lot of cases, can make some sense. There are certain instances where it doesn't make sense right now. So it's certainly not a blanket statement. It's unique to your situation. But in a lot of cases, having some money go to the Roth right now can make some sense. So the last item, and I'm going to check here on questions. Okay. From what types of accounts should you be withdrawing income? So let's say you're in the 55 to 65 age range, and you're starting to take income. How do you decide from which account to take income? That's one of the many things we have control over. We can't control the markets or geopolitical happenings, they happen, but we can absolutely control from which account we take income and when. So how do we look at that? Because the answer is it depends. If you're taking income, it's going to depend on your unique situation. So are you on Medicare? Have you started taking Social Security income? And if yes, and we'll go through an example here in a moment, what percentage is subject to federal income tax? We also want to look at how large will your required minimum distribution be at age 72. If you have an IRA at age 72, you have to start taking income out of that. It's taxable unless you give it to charity. Yep. So we want to look at, we would think about tax optimization, not tax minimization. Tax minimization only looks at 1 year and says, how can I have as low a tax rate as possible? Tax optimization looks at what are tax rates now? What are tax rates in the future? What are my known income sources in the future? Like I know at age 72, going to have a required minimum distribution. I know at age 72, I'm going to be on Social Security because the latest I would ever start is age 70. So we can pretty much project very close what your tax return is going to look like at age 72. And if we say, well, let's just minimize taxes right now, only to have kind of this tax time bomb at age 72 where your taxes are super high, that's not really ideal. We wouldn't consider that tax optimization. And then lastly, how diverse are your possible income sources? Now, if you have, let's say land rent, you have IRA, you have a Roth IRA, that's pretty diverse. We can get a little more creative. If you only have pre-tax, you only have a traditional IRA or traditional 401k, the options become a little bit limited. So that's where we, in general, like to have some diversification in terms of account types. And again, here's the tax returns. We want to optimize tax returns, not necessarily minimize tax. Taking advantage of these low rates under 340,000 can make a lot of sense right now. So let's look at an example. The concept is the exact same, but it's based on 2020 tax rates. This is a single person. Let's say have interest income of $500, some dividends and capital gains of $8,000. Take $5,000 out of their IRA. It's taxable. Take $25,000 as a qualified IRA distribution. That's tax-free. And let's say they get Social Security of $2,000 a month, so it's $24,000. So their gross income in this case is $62,500. Now their taxable income is kind of crazy. It's only $7,200 because that Roth IRA is not taxable, and you get everyone gets the deduction called the standard deduction. Yep. So now let's look at the next scenario. And the last thing I mentioned, so Social Security, remember the maximum Social Security, only 85% of that 24,000 could ever be taxable. in that tax return we looked at earlier in our discussion today, only $8,000 was taxable. So it looks at all your other taxable income sources. That determines how much of your Social Security is subject to tax. So in the right now, I've mirrored that exact same tax return, but I changed one item. You can see there highlighted, I changed the IRA distribution from $5,000 to $25,000. And the Roth IRA is now 0. So again, this is a choice. We can choose from which account to take income and when. And the choice in the scenario on the right is to take it all out of the IRA. So you see the gross income is the exact same, $62,500. So now I want you to think to yourself, what might the taxable income be? Well, we know it's going to be at least $25,000 higher because we took $25,000 more out of an IRA. What we'll see here in a moment, so kind of think to yourself, what might the taxable income be? We know it's going to be at least $32,200. So it's actually $50,100. So why is that, or what happened? All of the other taxable income sources determine how much of Social Security is subject to tax. So by taking that extra $25,000 out of the IRA, it caused a lot more, well, like $18,000 of Social Security that would have otherwise been tax-free to become taxable. So gross income, the exact same, $62,500. One, you have a taxable income of $7,200. You'd pay like $720 of federal tax. The other one, you're going to pay, I don't know the number, but it's, $7,000 or something like that of, probably more than that, of federal tax. So again, it's from which account to take income and when is something that's absolutely a controllable. All right, questions on there? We have one question on this. Would rental income, I don't have rental income on here, would that cause more Social Security to be subject to tax? Yes, it would, up to a maximum of 85%. 85% of Social Security is the most that can be subject to tax. So actually about right on time, 4:43 here Central Time. So we went through those four items: how and when to take Social Security, how your income impacts the costs of healthcare, and to what accounts should you be contributing and withdrawing. So yeah, I'll share with you. There's my email again, and Amber and Jacobs, all of our emails, our first name at sweetfinancial.com. So any questions, or if you want to link to where these past Sweet Financial Lives are saved on our website, certainly feel free to email me, and I'll pause a moment to see if I'm seeing any questions here. Otherwise, we will conclude. Let's see, I've already answered those two. I got one here. I'm going to reach out. I'll reach out to you individually here on that one that just came through. And yeah, otherwise no questions. I'm getting a few things through here in the chat box, some thank yous and good information. So appreciate the kind words.